Hey everyone, it's Aaron. There's an indicator that I like to watch that checks the health of the stock market. And this is one that is really about how much debt is being borrowed to buy stocks. It's called margin. So margin balances have been going straight up for the last 2 years, ever since the Fed really started to print hardcore to offset the effects of the pandemic. And with more money in the system, that means more stocks to buy. And that additional money to buy stocks is creating an upward draft. And this is something that I think a lot of people saw the opportunity. If the Fed was going to print a ton of money and put it into the economy and thus the stock market, they wanted to get on that train. And when you see a train's going up, well, it's always great to magnify your bet to increase your returns beyond your ability to get those returns with the original amount of money you had. So in this video, I'll be breaking down what margin is very quickly, and then showing you the actual balances that have been gradually increasing the last 2 years and are at all-time highs. And now, just in the last few weeks, they started to tick down for the very first time. And I think this is a precursor, an indicator of people's fear and getting prepared for something bigger to come, more like a downturn in the stock market. So go ahead, smash that like button, and it allows YouTube to show this video to people who are not just interested in the stock market, but maybe have investments or even leverage, and they need to know what's going on so that if the market does start to decline, they can de-lever and reduce their risk for loss if they get out ahead of time. So go ahead, hit that like button, and let's get started. All right, let's take a look at the website. So this is FINRA's website that shows margin statistics. And check out this table. So this shows month and year on the left, and then debit balances in the second column in customer securities margin accounts. So this is the amount of money that people have borrowed in millions across the nation. So if you look at the bottom here, November 21st, and then October 21st before it, $935 billion, and it just ticked down to $918 billion. So we're at almost $1 trillion in leverage from people trading. And this is if you're going to trade meme stocks, blue chip stocks, Apple, FANG, tech, it doesn't matter. All this money represents borrowed funds to buy stocks of any variety. And here's the thing. This is not just the highest in recent moments. This is the highest ever. Let's scroll down a little bit. We have 2020. We'll look at December of 2020. It was $778 billion. Let's look at the year before. December 2019, $579 billion. We're at almost double currently. Now, for context, let's just quickly scroll. I'm going to scroll far. Let's go back to the last recession, agnostic of 2020. We'll look at right before 2008 hit. So December, that November. Okay, now look at this pattern. So this is 2007. 2007 was an all-time high in the stock market before the last year and a half. And look at this, a fraction of the leverage that we had. And you see gradually, kind of on pace, 25, 30 billion. But then in November it peaked, and in December it started to tick down. So we scroll up, so then what happened? So in January, it went up again, because the market really started to crash in 2008 in Q1, in that first quarter. So people are pulling back their leverage and then seeing opportunities to trade. But it's much smaller amounts. So here's a graphical representation. So again, in the last 5 years, we see we're at, this is as of October, so the 935 billion, now we're at 918 billion. But look at this chart. So this is a helpful chart by Advisor Perspectives. And on the left-hand column, you have billions of dollars of margin. So that was basically just the amounts we were looking at, and that's the red line. Now the blue line is the S&P 500. So we're at all-time highs, both in the S&P 500, the stock market, and margin balances. And you can see this goes back well over 20 years. And these two gray bars represent the last 2 recessions before the one in 2020, which is very brief technically. And what it's trying to illustrate here is that margin balances were at their peak and preceded a fall in the stock market. Now, it's not necessarily a guarantee, it's an indicator though. So now that we've looked at this visually, I want to talk about how the implications of this will play out from the Federal Reserve's comments that are coming this week. So here's the deal. The Federal Reserve drives interest rates across America, and some would say also the world. And right now we're at effectively 0% interest. And so then on top of that, when they lend to banks, and then banks lend to consumers or businesses, and sometimes one other level outside from that, that's how you get all the way up to credit card interest rates being at 14, 15, 16% sometimes, depending on your credit. That's how you get, mortgages at 2.5%, 3%, 4%, because interest rates are so low. But when the cost of money increases, then it's going to make those interest rates go up. And that's going to make money, everything having to do with money really, more expensive for everyone who uses it, which is going to make people more risk adverse. So that same margin balance information I showed you, basically people will say, well, if my margin account is saying that I have to pay, X%, so let's call it, and usually it's about 5 to 10% depending on your account balances. If you have a lot of money, you pay lower amounts, but typically you start out around 10% interest, given this lower interest rate environment. But when you have to pay more interest, you're going to be more reticent to use that leverage to buy stocks. And so that means that the Federal Reserve is going to become more hawkish and want to taper back and pull money out of the economy and increase interest rates to create that economic disincentive to borrow. Then that's going to create a problem for everyone who's put money in the stock market, because the whole market is propped up by printed money over the last 18 months. And so when that starts to get pulled back, then people are going to sell stocks to cover their margin positions at a minimum. And they may be selling out of fear of the market going down. They want to lock in their gains. And knowing that we're in the end of December, basically, we're in the middle, but it's kind of crunch time. This is going to result in, I think, a big sell-off. People are trying to lock in their gains. They're trying to handle taxes. If they have losses, fine, they'll sell this year. Or if they have big gains, they also want to sell this year before higher tax rates become implemented, say in the infrastructure bill in 2022 and beyond. So people have a lot of incentives to sell. And this is just another one, throw it onto the pile of reasons that maybe it's time to sell before the year ends and walk away and see what happens. So if you're selling, that's one thing. But if you're levered up and then you're selling, you need to be able to sell and get out before everyone else really starts selling. Because if you have, say, a $50,000 account balance and you borrow another $50,000, now you have $100,000 that you've put into the stock market to buy whatever it is, say Apple. Well, if Apple starts going down, or maybe you buy a meme stock like AMC and it starts plummeting, well, actually those securities may not be marginable, but something that does move very fast. If it starts going down really far and you start to lose money, guess who takes the loss? You do, and the broker doesn't. So if your 100,000 gets, crunched down to 70,000, you still owe the broker 50,000, and now you've taken a larger loss on your position, and that's again the risk of leverage. So what do you guys think? Is this going to be one of the things, the canary in the coal mine, that we can look back to and say margin balances have been at all-time highs in the last two major recessions, and now we're on the precipice of potentially a third, depending what the Federal Reserve does? Go ahead, drop a comment, let me know your thoughts, consider subscribing, and smash that like button. Let's get this video out, because it's really important that people see this and understand the underlying dynamics of what's going on. All right, so hit that like button, and I'll catch you next time.